Hello everyone, welcome to today's video. In today's video, we'll be discussing how to analyze a bank stock and what are the important ratios that one must consider before buying a bank stock. Analyzing a bank stock is quite different to a stock from other sectors. I will tell you this with an example of debt to equity ratio. Normally, banks tend to have a very high debt to equity ratio compared to other sectors. This is because the banking system itself is highly leveraged. So, debt to equity has a very different relevance here. You will understand this when you know how a bank functions. The primary source of funding for the banks come through the borrowings. Now, where does the bank borrow money from? Banks borrow money from you and me in the form of deposits. We deposit our excess money in the banks through our saving accounts, current accounts, or maybe fixed term accounts like RD and FDs. Apart from this, bank can also borrow money from Central Bank of India, that is RBI. In case of emergencies or the shortage of funds, bank will normally borrow money from central banks also. For the money that we deposit in the bank, we will be getting certain interest rates in return from the banks, but it is generally very less. I think for the current accounts, bank is not paying any interest at all. Now the bank will utilize this deposited money or the borrowed money to lend to the borrower in the form of loan with very high interest rate. That's how bank makes money. The profit for the bank is the difference between the interest earned by the bank minus interest paid to the depositor. Now you can relate why the debt to equity ratio is very high for the bank. Because the banks are sourcing their funds primarily through borrowings and not by issuing the equities. Always remember, the deposit for a bank is an liability because bank has to pay interest to the depositors, and the loans or the advances that a bank makes is an asset for the bank because bank earn interest on their loans. Now we will see what are the important ratios and what is their relevance, and we'll try to understand each one of those ratios. I just want to clarify one thing. While explaining these ratios, I'll be taking the few bank names. That doesn't mean that I'm comparing those banks or doing any analysis on those particular banks. I just want to show you the ratios on those banks because I want to give you a look and feel how these numbers looks like. The numbers I'm going to display for these ratios is for the latest quarter concluded, that is for December 21st. That means these numbers are only for the one quarter. So it's simple, one cannot judge a bank by the numbers of any single quarter. The purpose of this video is to make you understand these ratios. Once you understand these ratios, you can do the analysis of any bank on your own. When analyzing any bank stocks, you must see these ratios on a sequential basis as well as year-on-year basis. Now let's move on to our first ratio without wasting further time. The first ratio that we are going to look is the CASA ratio. Now that we understood how a bank functions, now it is easier to understand CASA ratio. CASA ratio is nothing but the percentage of current account and saving accounts of the total deposits in a bank. Now let's understand this with an example. Let's consider I have a bank and I have total 100 accounts in my banks, out of which 30 are the saving accounts and 20 are the current accounts, and remaining 50 are the fixed deposit and RD. Okay. Now if I have to calculate CASA ratio of my bank, it's simple. I just need to add both current account and saving accounts, that is 30 plus 20, that comes to 50, divided by total number of deposits, that is 100, that comes to 50%. That means 50% of my total deposits are in current account and saving accounts. The more the number, it's better for the bank. As I said earlier, bank pay very little interest for the current accounts and saving accounts in comparison to FD and RD. A high CASA ratio will benefit the bank to improve their net interest income because, as I said, bank will pay very little interest for the current accounts and saving accounts. The bank will use the same money to lend to the borrower with a higher interest. Now let's move on to the next ratio. This is called as gross non-performing asset, that is NPA. This is a very important ratio for any bank that tells us the asset quality of a bank. Now, what is an asset for a bank? I told you in the beginning, an asset is the loans that is lended by the banks to the borrowers. Non-performing assets is the sum of total unpaid debts. For example, bank would have lended 100 units of loans of different categories. Out of 100, there would be some borrowers who will not pay their principal or interest on time. If a borrower does not pay the interest or the principal amount for more than 90 days, then those loans will be termed as bad loans or non-performing assets. This can be expressed in percentage term, that is, how much percentage of the total advances have been turned into bad loans. In this case, lesser the number is good for the bank. Now there is something called as provisional coverage ratio. This ratio is in very much connection with the previous ratio that we just discussed. Now we have learned what is a non-performing assets or the bad loans. When bank gives out the loans, for example, a bank has given a 10 units of loans, and bank will have a certain estimation that out of 10, some of their loans will be defaulted by the borrower. In this case, what bank does is they will keep a portion of their profit set aside in order to cover these losses. Let's say the gross NPA is 100 rupees and bank has made a provision for 60 rupees. In this case, the PCR ratio would be 60%. The provisions made by the banks can be expressed in terms of percentage of gross NPA. Now we know what is the gross NPA. So gross NPA is not the total loss for the company or the bank because there is a provision made against this. Now when it comes to net NPA, this is another important ratio. This is the actual loss for the banks. To calculate this, very simple, the gross NPA, we will take the previous example only. In the previous example, we have considered 100 rupees as gross NPA. So, gross NPA minus provisions. Provisions made is 60 rupees. So, the remaining is 40 rupees. So, 40 rupees is the net NPA, the actual loss for the bank. Again, the net NPA can also be expressed in terms of percentage of total advances. Total advances is nothing but the total loan amount given by the banks. The lesser the net NPA, better for the bank. That means bank has a very good asset quality. If you like the video, please press the like button and subscribe to my channel because those are the indicators for me whether I am doing the good content or not. Let's move on to the next ratio that is called as capital adequacy ratio. We can also call it as CAR. Capital is nothing but the money, adequacy is sufficient. So what does this tell us is whether the bank has a sufficient capital or not against the risk that has been calculated from its assets. I am repeating again, the assets are nothing but the loans that has been given by the banks. When I say loans, there will be hundreds of different categories of loans. So each of those loans will be attached with a certain percentage of risk. Let's say bank has given a car loan and the person who has bought the car and bought the loan from the bank is not able to repay his debt. Now what bank can do maximum is bank can acquire that car and sell that car and try to recover its loan amount. Though bank not able to recover 100% of its amount, so there is a certain amount of risk is there. I hope I simplified enough for your better understanding. In general, this is nothing but the asset classification, and each class of asset has a different level of risk attached to it. So when you sum up all the risks from the different asset classes, banks should have a minimum capital requirement in order to mitigate this risk. The capital could be the shareholders' equity or the reserves, or it could also be the retained profits of the bank. As per the RBI norms, the commercial banks should maintain a minimum CAR of 9%. 9% of CAR means bank will have a 9 rupees worth of capital for every 100 rupees in assets. Let's move on to the next ratio, that is credit to deposit ratio. It's a simpler one. It indicates how much a bank lends out of its deposits. The higher the ratio, the better is the earning capacity of a bank. Now see the next ratio called as net interest margin. By now we know what is the net interest income. That is nothing but the interest earned by the bank minus interest paid. Okay. NIM is nothing but the net interest income earned by the bank in a percentage term on the average interest earning assets. Average interest earning assets means you cannot consider the non-performing assets in this calculation. Now what is average asset? Okay, let's consider you are calculating the net interest margin for any one quarter. The banks will calculate the average of the earning assets from the beginning of the quarter till the end of the quarter, because these earning assets, it's something like that vary every day. The number that you are seeing on your screen for this ratio, that is for the NIM ratio, is taken from the annual reports of March 2021. So this is inclusive of 4 quarters. The last but not the least is return on asset. So it is again profitability ratio, the most commonly used benchmark for banks' profitability. So it indicates how efficiently a bank manages its asset to generate profit for the bank. So anything above 1% is considered as pretty good for the banks. The ROA numbers that you are seeing on your screen is taken from the annual reports of March 2021. That means this is calculated on the annual basis. This can be calculated for any specific period. I hope you enjoyed the video and I have added some value to your learning process. If you like the video, please press the like button and subscribe to my channel. I will see you in the next video.